All right, everyone. We'll start this back up since it's 1 p.m. So sorry about that little issue that we had over the break. So Tony, I will introduce Tony. Tony is a longtime collaborator of the Montreal Exchange. He is a specialist into the financial service industry with over a decade of experience spanning product development, research, and market strategist role across equities, foreign exchange, and derivatives. As the current head of product strategy for OptionsPlay, Tony leads the research and development of their OptionsPlay ideas and portfolio platform. Tony also spent 7 years at Forex.com with a capital market and research background as a market strategist specializing in equity and FX derivatives market. So today, Tony will learn you about the directional views on earning announcements with limited risk using options. To do so, he'll use Options Place platform as well as MX Trading Simulator. The timing couldn't be better since we are currently starting the Q1 earnings season. So Tony, have a great presentation and I'll talk to you later.
Thank you so much, JP. Thank you so much for the Toronto Montreal Exchange for hosting this wonderful event. As you know, my name is Tony Zhang. I'm the chief strategist here at OptionsPlay. And like Jean-Philippe just said, first of all, I just want to welcome everyone to our first virtual options education day. Thank you so much for joining us and being a participant here. I hope everyone is staying safe and staying well. And I'm really excited to kick off earnings season. This is arguably one of the most important earnings seasons, at least probably in my trading history. It also at the same time is probably the least meaningful simply because there's not a lot of data points that's going to be useful going forward, or for this particular quarter. But going forward, the data that we're going to get is really going to inform our market outlook. So I think it's really important that we cover this earnings season because we do expect a lot of volatility as companies have pulled guidance and there's a data vacuum right now, and whatever data we can currently get our hands on from these companies will likely have large shifts in terms of stock pricing. So we really want to make sure that you utilize options when you look at earnings season, this particular earnings season specifically, because you want to use options to trade it with limited risk. So let's go ahead and get started. Before I do, just a quick disclaimer. What we're going to discuss here today is purely for educational and information purposes. It is not a solicitation or recommendation to buy or sell any specific securities. Now, before I jump in and get started, I just want to make sure everyone is familiar with the partnership that OptionsPlay has with the Montreal Exchange with respect to all the different tools, education, and platform that's available to you free of charge, courtesy of the Montreal Exchange. So later, I'm going to show you a set of tools. I'm going to show you OptionsPlay. I'm going to show you the trading simulator, but specifically the OptionsPlay platform is completely available to you free of charge. You get access to the full platform that I'll show you here in a few minutes. You get access to bi-weekly options education webinars, a full video library for you to go back and watch the recordings of each one, and then weekly cover calls and short put reports. So a wealth of tools that are all available to you completely free of charge. And you can sign up at optionsplay.com/TMX. So we'll come back to that in a few minutes so that you know how to sign up for that. So let's go ahead and talk about what we're going to discuss here today. So first of all, we're going to talk about Q1 2020's earning preview. So I want to go through what sectors I'm paying attention to, what sectors I think are likely going to have some significant impact in how we look at the outlook of the particular markets. So giving you a little bit of preview as far as what we're expecting. Then we'll talk about the option strategies that you might utilize for your trading here. We're going to talk about strategies whether you're buying because you're trying to speculate on a stock that's going to beat or miss on earnings, or strategies that allow you to sell when you expect the earnings event to be somewhat neutral, when you don't expect the stock to make a big move, how you can utilize options to do so. But all of the strategies we're going to cover here today are strategies that have limited risk. And it's really important that we learn how to utilize options with limited risk because earnings seasons can be very volatile. You can open yourself up to a lot of risk. So we want to make sure that you understand how to go about utilizing options. Now, before you can actually start deploying these options on your portfolio, it's important to also understand how option pricing works around earnings, because it is quite different around earnings than any other time. So we want to make sure you understand what factors are at play, how to quantify those factors so that you can be self-sufficient in analyzing option strategies on your own using platforms like OptionsPlay. Then what we're going to do is we're going to look at the earnings calendar together. I'm going to show you the earnings calendar that we've put together for you so that you can prioritize symbols based on liquidity. It's important that when you're trading earnings, especially during high volatility, that you focus on the symbols that are most liquid. So we're going to show you how to identify which symbols are most liquid on the earnings calendar. And then lastly, we'll try to do as many live examples using the P&L simulator to show you how to analyze an options play going into earnings and see how they would potentially play out if the stock makes a big jump or misses on earnings. So those are the things we're going to go over here today. Before we jump right into it, I just want to do a quick introduction as to who I am. For those of you that are familiar or not familiar, my name is Tony Zhang. I'm the chief strategist here at OptionsPlay. Some of you might know me as the anchor on OptionsPlay on Options Action on CNBC every single Friday at 5:30 p.m. Now, just to give you a little background, my background heavily came from technical analysis as a market strategist for currency traders. So for those of you that like to trade Forex, you might be familiar with a company called Forex.com. I spent many years there dealing with retail and institutional traders, helping them better understand market color, understand technical analysis, so that they can trade the currency markets. And that's really how I learned how to use the charts, how I learned about strategy, and that's when I also learned how to trade options. And I had the opportunity to start OptionsPlay about 7 years ago to build financial technology and build financial education specifically around options trading. And these days we provide our services to brokerage firms, global exchanges like TMX, and wealth management firms across US, Canada, and the Nordics. And so our technology is utilized in a lot of different places. And we want to show you how we can take what we've built to help you improve your options trading. So let's go ahead and jump right into the Q1 earnings preview. So Q1 2020 is important for us because it is the first earnings cycle that includes some portion of the COVID-19 economic shutdown globally, not just in Canada and everywhere, but globally. And it's really important for us to look at these earnings numbers to give us a better understanding as to what was the impact at the end of March as a result of shutdowns, and then help us also provide some guidance as far as what's going to happen in Q2 and when we can expect some of these companies to look at recovery and look at getting back to normal. So that's why this earnings season is so important. I would say the actual numbers themselves are not very important. What's more important is actually the guidance that they provide going forward. As far as banking goes, I think we can really look back at 2008 and 2009 to provide somewhat of a roadmap here as far as how banks are going to see their guidance going forward. At this point, we don't anticipate Canadian banks to cut their dividends. We see that as a fairly unlikely scenario, given the fact that this is not a financial crisis. And even during 2008 and 2009, when this was a financial crisis and liquidity was a problem, the Canadian banks did not cut their dividends. So we expect that to stay in place here for 2020 Q1 for the Canadian banks. So this provides, in my personal opinion, a bit of support for some of the Canadian banks at the current price levels and seeking opportunities to invest in some of these stocks. That's my personal opinion. As far as energy goes, the oil decline continues to sustain the declines. And from my perspective, this actually speaks to me more than any other economic indicator that we can look at, because pricing on oil is real time. It factors into real time demand of what not just US, Canadian, and global economies need, but the fact that there's almost no demand for this oil that's currently coming out of the ground. And we've seen some of the oil futures going negative last week. That shows us just how little demand there is. That shows us how little optimism the market currently sees as far as us getting back to normal in the next month or two. We really have to go out to significantly longer futures contracts in order to see some normalization of future of oil prices. And that, for me, speaks to some of the economic decline that we truly are in. And from my perspective, that provides some opportunities in the energy sector, meaning I certainly think there's going to be further weakness in the energy sector. I think Q2, Q3 is going to be a very, very challenging time for a lot of these companies. The consumer market, unemployment and GDP numbers continue to surprise us to the downside. So I expect to see some more potential retail bankruptcies in this particular space, especially as companies that are not focused on digital strategies, especially companies that are focused more so on physical store sales. Those are going to be the bifurcation that we're going to see in the consumer space. Companies that have a digital and online strategy will tend to do okay and survive this relatively intact. Companies that are focused on more physical stores like Dollar Tree, which has a very large Canadian presence, I think are going to struggle. And then when we look at cannabis, the trends here still remain very muted, and the trends here remain very poor. A lot of interest in cannabis companies. A lot of Canadians love to trade those names. So we want to make sure that everyone understands that, you know, based on the current outlook that we see with the cannabis market, we don't really see an upside at the moment here for cannabis, at least during the coronavirus, at the data that we're currently looking at. So that's just a quick preview of the different sectors that I, as a strategist, am focused on for Q1 2020. Now let's take a look at how we can trade these utilizing options. So first, what we want to do is we want to cover what are earnings. Why do we want to trade earnings? So first of all, let's cover what earnings are. So for those of you that are trading stocks, you're probably already familiar with earnings. Earnings is really when a company provides guidance 4 times a year on their revenue, their profits, and forward guidance as to how they anticipate their business will look in the next quarter, in the next year, and any type of guidance they can provide, whether positive or negative. The guidance is really what we've been lacking for this particular quarter, because going into this quarter, companies also themselves, having no visibility into how things are going to perform, pulled a lot of that guidance, and they weren't able to provide us as to insights as far as where they think revenues and profits were going to be. So some companies, especially in the US, you know, have been able to provide some guidance here. So it's really important that we look at that guidance to give us a sense for how we expect the outlook to look. Now, why should we care about this? Why should you trade earnings? And for many people, some people may not like to trade earnings simply because with the earnings event comes extreme volatility. Because if the company announces earnings and revenue that comes outside of what analysts are expecting or what the market is expecting, the stock will usually have a big jump higher if they beat earnings, or a big jump lower if they missed on earnings. Now, the one thing I will say for this particular quarter, I think that what's going to matter less for many people is the actual revenue and the profits, and more so the actual forward guidance that they provide. The guidance, in my opinion, will provide a lot more information than just how they did in terms of revenue and profits for Q1, which we obviously all expect at the end of March to come down a little, but I think Q2 is really the big number that most people are looking at, and some companies have been providing some guidance as to what they expect. So having that guidance, in my opinion, is likely what's going to drive a stock's price this particular earnings season, more so than what they report in terms of revenue and profits. Now, this repricing, if you will, right after an earnings event is the tradable event. So for those of you that are seeking volatility, this is the best type of volatility because it happens instantaneously. It happens overnight. If you're able to be on the right side of that volatility, you can make a lot of money. If you're on the wrong side of that volatility, you can lose a lot of money. So how can you trade earnings? Now, first of all, for those of you that are stock traders or stock investors, you're familiar with the fact that as a stock investor, you can buy the stock on a stock that you think is going to beat and rally, and you can short the stock on a stock that you think is going to miss and decline. Now, if you buy or sell a specific stock, this is where you have an unleveraged position. So, and meaning you have to put up all the capital in order to either buy or short the stock. You have symmetrical risk, and this is the part that I think is difficult for a lot of traders, because if you get the direction wrong, you can take on a substantial amount of risk. And that's not the risk that everyone necessarily always wants to take. And when you buy or short a stock, you truly have what I consider unlimited risk, because the stock can move significantly higher or lower. There's no limit as to how far a stock can move higher or lower, with the exception of zero. A stock technically cannot go below zero. So you do have limited risk of the downside, but you truly have unlimited risk when you short a stock. So the reason that we're all here today is because we want to show you how you can utilize options to, number one, apply leverage to your directional view. Now, many times leverage can be seen as a double-edged sword, right? If you get the direction correct and you have leverage, great. But if you have direction wrong and you have leverage, then you could blow up your whole account. But that's really where options come into play, because you can apply leverage, have asymmetrical risk, but do so in a way that has limited risk. So today what we're going to do is we're going to explore different option strategies that allow you to apply leverage, but do so in a way with limited risk. So let's go ahead and jump right into some of the nuances of trading options around earnings. And then what we're going to do is we're going to come back to the different strategies we can apply. So first, I want to talk a little bit about options trading. Now, trading options around earnings is a difficult task. And the reason I say it's a difficult task is because I call it one step forward, two steps back. And the reason I say that is because when you're trading options, you have one thing that can potentially work in your favor, while you have two things that is always working against you. And we're going to define what these things are and help you quantify them in the next slide. But let's first just talk about the concept. Let's not talk about any specific numbers. So when you're trading options, you can obviously call the directional view of the stock correctly. Now, if you're able to call the directional view of the stock correctly, then that's where you're able to have a large gain on that potential beat or miss. And that is really where most options traders want to be, is they want to call the directional view, they want to call the directional view on a gain or a loss. So if the stock makes a big move to the upside or a big move to the downside, they can profit or loss, they can have a big profit or potentially a big loss from that. But if you call the direction correct, that's your potential large gain on that beat or miss. But on the flip side, there's always two things that's actually working against you when you're trading options. And the first thing is called volatility crush. Now, for those of you that are not familiar with volatility crush, what that is that right before an earnings event, there's a lot of uncertainty around where the earnings announcement is going to be. So for anyone who's trying to buy a call option or a put option, the price of that call or put is naturally going to be a little higher because there's a lot of uncertainty. The stock can make a big move, so it costs a little bit more to buy that call or put. Now, once the earnings announcement comes out, once the information is out, the call or put will actually reduce in price just because the uncertainty factor is out. There's no more uncertainty. We know what the earnings announcement is. So as a result of that, the volatility or the implied volatility of a call or put that you purchase will actually decline as once the earnings announcement comes out. So when you buy an option, you want the value of your option to go up. But what volatility causes is the value of your call or put to reduce in value. So that's one of the first factors that works against you when you're trading options. And keep in mind that this volatility crush, it doesn't really come into play in any other environment outside of earnings. Yes, the implied volatility of your option will change throughout the life cycle of your option, even if there are no earnings coming into play. But one of the biggest changes one of the biggest changes to implied volatility is around the earnings announcement. It becomes elevated right before the announcement, and then it comes right down, right back lower right after the announcement. And the third category, or the third thing working against you, or the second thing working against you, is what we call time decay. Now, time decay works against you at all times, whether there's earnings or not. Time decay is something that affects the value of your option. So now I will say that out of these three factors, the gain in the underlying stock, or whether the stock goes higher or lower, has the largest effect on the value of your option. The volatility crush has, in my opinion, the second largest effect on the value of your option. And time decay, even though time decay is a factor, most of the strategies we're going to discuss here, and thank you, HK, time factor is the only thing here that when you're trading options, you generally aren't holding on to an option for too long. So time value here is actually relatively small. So out of these three things, the large stock gain has the largest effect, volatility crush has the second largest effect, and time decay has the third largest effect here. So how do you profit, or how do you potentially profit from earnings? It really comes down to having a stock that makes a large enough move in the underlying stock where the value of your option increases large enough to offset the decline in volatility crush and the decline in time decay. So you need a large enough stock move in one direction to offset the volatility crush and the time decay. And it's basically simple math of an equation, right? On this side of the equation needs to be large enough to overcome the volatility crush and time decay. So at this point, I just want to make sure everyone understands this. I want to discuss these in more numeric terms so that you have a better understanding of these. But before I do, does this concept make sense to everyone? Before I move on, please type 1 into the chat window if this makes sense to you. Okay, perfect. See a lot of ones going by. So now let's talk about some of these three factors in more numeric examples. So this is where we're going to turn to the Greeks. Now I don't have enough time to go in depth into the Greeks, and for those of you that are interested in learning more, we have recordings just on this topic alone, so please feel free to review some of that after today. But we're going to talk about three Greeks: delta, vega, and theta. These are the three Greeks that have the largest effect on our value of our options around earnings. And those are the three factors we just discussed. So delta tells us the change in the price of the option with respect to the change in price of the stock. Vega tells us the change of the price of the option with respect to volatility. That's the volatility crush. And theta tells us the change in the price of the option with respect to time. That's the time decay factor that we were speaking about. So if you have a call option that you purchased and the delta here is 0.5, that's telling you for every $1 the stock moves higher, the option will move 50 cents higher. So let's say you have a $4 option that you buy on a stock going into earnings, and let's say the stock makes I don't know, a $10 move higher. So $10 multiplied by 0.5, meaning the value of the option increases by $5. So based on delta, your value of your option is now worth $9. Now let's say due to vega, let's say the volatility decreases by 10%. So what you do is you subtract $2.50 from the value of their option. So now you have an option that's worth $6.50. And let's say this takes a week for this to happen and you have a theta of 0.1. So then you reduce another 70 cents off of that option. So now you have an option that's worth $5 and $6.50 minus 7. Sorry, I'm losing my mind here. So now you have an option that's worth $5.80. So you have delta that increases the value of your option if you call the direction correct. You have vega that's working against you, that's the volatility crush, and then you have theta that's always working against you. So this is the kind of 1 step forward, 2 steps back that I'm referring to that gets you your value originally from $4 for the call option that you purchased, and eventually down to $5.80. So you're going to say to yourself, well, that's great, but how do I actually calculate this on an actual strategy that I'm looking to trade? So that's exactly what we're going to cover here in a few minutes. I'm going to show you the platform that actually does the math for you so that you don't have to actually do this math, but this is just a quick and dirty numerical example so that you can see as the price of an option increases after earning, once you factor into volatility and once you factor into theta, how you can roughly get to an understanding as to how much the value of your option will be worth going forward. So let's start jumping into the strategies themselves before we start taking a look at some examples. Now, this is not meant to be a in-depth discussion on option strategies. Patrick will cover some of these strategies with you next. This is designed to give you an understanding of the application of these strategies. If you're brand new to options trading and you want to learn more about these strategies, we have whole sessions dedicated to teaching you these specific strategies, but we did want to spend most of today less so focused on the mechanics of options trading, but more so on the application so that we can show you how to apply these strategies. And then you can go back and learn the mechanics of each one of these strategies if these are new. So whenever we're talking about bullish and bearish strategies going into earnings, this is referring to a stock that you think is going to beat on earnings and move significantly higher, or miss on earnings and move significantly lower. Now, generally speaking, with both of these strategies, you generally want to pick expirations that are at least 2 to 3 weeks after the earnings announcement. So we get a lot of questions from users saying, okay, I want to buy a call option on a stock. It reports earnings next week. Should I buy an expiration that expires next Friday? And the answer is, generally speaking, you want to give yourself a little bit more time after the earnings expiration, because stocks can move a little bit after earnings. You don't want to hold it just a few days before earnings, generally speaking, because time decay becomes a bigger factor as you approach expiration. So to reduce that time decay and keep that factor a relatively smaller factor, you want to go usually 2 to 3 weeks past the earnings event as your expiration date. Now, for this, you have two general strategies that we're going to discuss here today. The first one is a simple strategy. This is just buying a call or put option. This is exactly what Luke covered with you in his previous session here. This is when you're expecting, generally speaking, a big move in the underlying stock. So think about smaller cap names, think about marijuana stocks, think about names that are fairly volatile, that when they report earnings, they tend to make big moves, as opposed to, let's say, some of the banks or some of the larger oil companies, or maybe some of the telecom companies or utility companies. They don't tend to have big jumps in their stock price as a result of earnings. So the long call and long put are more focused on the stocks that you have more of a bigger expectation of a move, where you want an unlimited profit potential. You think the stock's going to make a big move. The downside to the strategy is that you do have a larger amount of capital at risk. So it's really important that you know that when you're trading these types of strategies, they are higher risk, but they also come with unlimited profit potential. So when you do get that really big move on earnings, you can capture that through a long call or a long put. Now, for those stocks that are more large cap, mega cap stocks, especially some of the banking stocks that don't move a whole lot, their beta is relatively small, their volatility is small, or maybe some of the telecom stocks where you might have an expectation of a bullish or bearish move, but maybe you don't expect the stock to make a big move. So you have more of a modest or slower move that you're expecting. The strategy that you want to use there is a long call vertical or a long put vertical, specifically the debit vertical spread. Now, if you're not sure what that is, that's okay. This is something that it takes time to learn. It is really, in my opinion, a graduation of long calls into a strategy that's just that provides a smaller amount of risk a smaller amount of capital at risk using a vertical spread. So it's important that you learn that, especially if you're in the process of learning how to trade options, because this strategy provides what we consider a limited profit potential, but it does so in a way with a smaller amount of capital at risk. So what this allows you to do is basically speculate on a stock that you think is going to make a move on earnings, but maybe you don't expect the move to be that large. So you want to put a smaller amount of capital at risk, because you are risking a significant amount of capital, generally speaking, when you're trading earnings. So with stocks that you don't think they're going to hit it out of the park anyway, you want to risk a smaller amount of capital, limit your profit potential, and you can do that using a call or put debit vertical. Now, I also get a lot of questions around when do you enter and when do you exit these types of strategies. So for both of these types of strategies, generally speaking, you want to get into it right before earnings. You don't want to buy a call option a month before earnings. Yes, volatility will be cheap, but then you're exposing yourself to a whole month of price movement, and you're not really getting a lot of value for that. So you generally want to buy right before earnings, 1 to 3 days before earnings, and you generally want to exit this trade usually 3 to 5 days after earnings, because if you're expecting a big move, usually those moves will happen within 3 to 5 trading days. So whenever you expect a big move, buying a call or a put on a stock that you think is going to make a big move, and then a debit spread for a stock that you think is going to make a more modest or perhaps a slower move. So those are for strategies that you expect the stock to beat or miss. Next, what we're going to cover is a strategy that for a stock that you think is not going to make a big move. Now, there are plenty of stocks where perhaps based on information that's well known, you simply just don't think the stock's going to make a big move. And there's plenty of stocks that historically do not move very much on earnings. So a more neutral strategy, if you think a stock's not going to move, is you can actually sell a credit spread. So credit spreads are useful for symbols where you expect that the stock's not going to move, but also one of the features of a credit spread, and for those of you that are not familiar with the credit spread, I recommend you to learn about that after we finish here today. But a credit spread is the only strategy where the vol crush and time decay, so the two things that I said that works against you in an option, actually works in your favor. Now, the key here to remember here with credit spreads is that credit spreads have a limited profit potential, which many times when you're trading an earnings announcement, you usually don't want to limit your profit potential. But for a stock that you think is going to be neutral, there's no need to try to shoot for the moon here, if you will. But the thing that you have to remember here when you're selling credit spreads, yes, volatility and time decay is working in your favor, but you're putting on a substantially larger amount of capital at risk. So it's not a strategy that I recommend beginners to start with because you're risking more capital than what you can potentially make on an earnings play. So many times you might be collecting $100 in potential reward, and on the back of that, risking $200. So again, not a strategy for beginners, but this is a more advanced strategy for experienced options traders that know what they're doing with respect to earnings, and they want to sell some premium. This is one of the ways that you can sell premium going into an earnings event, but do so in a way with limited risk. And just like the buying the option strategies, you generally want to enter these trades anywhere from 1 to 3 days before earnings, and then exit them usually within 3 to 5 days after earnings. The reason that also this strategy isn't very popular is that many times, even if you get a big move in the underlying stock in your favor, you actually do not capture most of the gains until you hold the credit spread to expiration. So that's really, again, some of the reasons why credit spreads are not very commonly traded on earnings, because the earnings event itself many times is not what contributes to your P&L. It's actually waiting and holding it to expiration that theta really doesn't kick in at first. Volatility crush kicks in a little bit, but theta doesn't kick in until you actually hold it to expiration. So those are the reasons why many times for many traders, they prefer utilizing buying a call or perhaps a debit spread. So with that, I want to start taking a look at some real examples because I think that's the best way to learn. However, before I do that, I just want to show everyone we're launching a new earnings calendar that you can access directly using the link that's on your screen, trade.optionsplay.com/CA earnings cal. And what this does is it provides you with an earnings calendar that not only tells you what symbols are coming up in terms of earnings date, it gives you by date, but it also provides it color coded for you based on liquidity. Now, I find liquidity to be one of the most important factors to look into when you're trading earnings. Now, when you're looking at an earnings calendar, there many times could be tens or 30, 40 symbols reporting earnings on that day. How do you know which ones to focus on? I prefer focusing on the ones that have the most liquidity. So our earnings calendar is actually color coded for you. The ones in green, which are denoted as 1, are the most liquid symbols. The ones denoted 2 in yellow are the second most liquid symbols. Anything that's rated a 3 is really something that's not very liquid. So if you're trading those options, be very careful that you understand the risk with trading those types of options. So with that, what I want to do is I want to show you options play. I want to show you some real examples of stocks coming up with earnings to explain how to utilize our tool to understand how to analyze an upcoming earnings earnings report, and also show you the trading simulator so that you can actually simulate some of those trades, especially for those of you that are brand new to options trading. When you're starting out, you might want to play some practice trades, see how they perform around earnings, because that will be invaluable information for you when you pull the trigger on your real trading account. So the screen that you see here right now is Options Play. This is the tool that's available to everyone in Canada completely free of charge, courtesy of the Montreal Exchange. So the platform itself is divided into 3 sections. On the left, you have trade ideas and watch list. In the middle panel is our security analysis panel. And on the right-hand side, we have trading and we have income. Now, these three panels are the what, the why, and the how of options trading. So when you start your morning, you want to know what symbols should I pay attention to. You can see trade ideas, that are technical analysis scans that provide you with bullish and bearish ideas for the day. You have watch lists that are pre-built for you, or you can create your own watch list. I've created one for stocks that are reporting earnings in the next week. The security analysis panel provides you with both 1 month and 6 month trend analysis, as well as relative strength data, so that you can quickly get a sense for the trend of a stock, whether it's a strong stock like Barrett Gold and some of the mining stocks versus the cannabis and energy companies that are weak and exhibiting bearish trends. Using a watch list very quickly, everything is color coded for you, and so that you can get a sense very quickly of the directional trend. When the next earnings date here is right below your chart, very important to know exactly when a stock is reporting, the next dividend, and then more importantly, showing you how to leverage some option strategies to trade your directional view. Now, many of you that have traded options, you're probably familiar with the options chain. So many times we're all used to utilizing the options chain in our trading. And when we trade with the options chain, many times, sometimes it's a little confusing to know exactly where to start, right? So when we're looking at an option chain, you have hundreds of expiration dates and strike prices. So it takes some time to figure out exactly what strike you want to start off with, what expiration do you want to start off with. If anyone has, the same difficulty there, please type yes into the chat window. If sometimes when you're looking at the option chain, you're not exactly sure which expiration date, what strike price, and even if you knew what expiration date and strike price, we tend to find that most people, they're really just kind of guessing when they're picking a date. And after they pick a date, they're not sure exactly whether they've picked the right one or not. So that's why here at OptionsPlay, what we do is not only do we select the strategy for you, we select expiration dates, we select strike prices. I saw a couple of questions before when I was doing the slides on the options. People were asking, well, how do you pick expiration date? Do you pick at the money, out of the money, in the money? Well, not only do we teach you those best practices, we actually help you implement them using our tool. So I'm looking at Enbridge here. Enbridge is a natural gas provider in Canada, predominantly in Calgary. This stock has really been trading in a very tight range here between, kind of into this bit of a triangle here, and it reports earning here on May 7th, so about 10 days away. Now, I would say it's a little early to get into this particular trade. I would generally wait a few more days to get in, but I just want to show you, a potential energy stock. Now, this is one of the energy stocks that actually is doing okay. It's got a technical score of 5, meaning it's performing on par, generally speaking, with the market. So it's not underperforming the markets like Sucor Energy is, but it's not outperforming the markets. It's really very neutral. So this could really go either way. So I wanted to show you 2 strategies that we can play here. So I can either select I'm bullish and see 3 bullish strategies, which includes that call option and that debit vertical spread that we were referring to, or I can select I'm bearish, and then it'll show me the bearish strategy and the bear debit spread here. So what I want to do is I want to show you these 2 strategies and show you that if let's say I buy a call option here on Enbridge, right? So as I said, that generally speaking, you want to pick an expiration date that's a couple of weeks after earnings. So if this reports earnings on May 7th, I would usually pick either the May 22nd maybe here, which is 2 weeks after earnings. If I pick up the May $40 call option, so this is the at the money call option expiring 2 weeks after earnings, what this allows me to do is actually use my P&L simulator to say, well, what happens if Enbridge jumps a little on earnings? Let's say it jumps up to $44 a few days after earnings, which let's say is May 10th or so. So this reports earnings on May 7th. So let's say on May 10th. And volatility, remember, there's a volatility crush that's important. So volatility currently is trading around 33. There isn't exact science here as far as how far it can go, but I usually knock off at least about a quarter of the implied volatility, so maybe down to around 25 here. And as you can see, what this P&L simulator does is it takes the option strategy that I picked, right? Whether I had good reason or bad reason to pick this specific option strategy, it tells me exactly how much money I could expect to return if the strategy makes that jump up to $44 on earnings. a few days after earnings, despite the fact that volatility comes down, I'm looking at 126% return on the $178 that I'm putting in for this particular call option. It also allows me to say, well, what happens if I'm wrong and Enbridge misses earnings and comes down to, let's say, 37 bucks? I know exactly how much money I lose. I basically lose everything. I lose $174 out of the 178, or 97% loss. But on the flip side, if I'm right, I'm getting 126% return, right? So this allows me to quickly analyze, is the risk reward of this particular strategy worth taking on the kind of risk? Now, in this particular example, I would say that the risk actually looked pretty good. I'm looking at 126% return. And if I'm wrong, no matter what happens, even if the stock goes significantly lower, I'm only risking $178. No matter what happens, that's the most I can risk. And you could also take a look at this call spread here. I don't have enough time to get into some of the details of the vertical spread here today. I want to focus on just the basic strategies first, because you can always apply what you've learned here in the basic strategy to the debit spread. So let's focus more on the debit, just the basic caller and put first here today, and show you that if you just bought this May $40 call option, exactly how you can calculate what your expected return is, what your expected loss is if the stock goes higher, if it goes lower. This is the information that you need in order to make a trade, in order to make a decision as to whether it's a trade that you want to make. And again, I want to show you the trading simulator that the Montreal Exchange has, that you guys all have access to free of charge. We've sent you a link before the event to show you how to register, but we'll send one to you afterwards as well. But you can use the simulator to find an option. So let's look at the Enbridge option. Whoops. Enbridge, you can select your option trade. And then you can select your expiration date. So we were looking at the May 22nd, $40 call option. And it'll tell you it's currently trading at 161 by 181. Now, I selected Enbridge because Enbridge is one of the symbols that it's reporting that is very liquid. So when I look at the bid-ask spread, I'm not surprised that it's 161, 181. It's fairly reasonable bid-ask spread. So I can choose to place a limit order inside the spread, or I can choose a market order if I just simply want to pay the asking price. In this particular case, the midpoint's here at 171, so maybe I might put in a limit order at 175, and I can preview this order, and I can choose, say that, you know, with a $9.95 commission, here's my estimated total, and I can go ahead and trade this. And once I place my order, I can go to the order manager and see my outstanding orders here. So I have this Enbridge buy May 22 $40 call option for 175. This is currently still open. I can see all of my filled orders here below that, and then I can always go to the dashboard and see my outstanding positions here under positions. So I actually already have a Enbridge $40 call option that I entered this trade here before, and you can utilize this platform to simulate trading. A lot of questions that I get from traders asking, you know, how do I practice trading options? This simulator is the best way, in my opinion, to allow you to practice trading options, see your positions, and really get an understanding of how to place orders for your options trades before you pull the trigger on your real account. Okay, so let's look at a few more examples here. Let's look at Barrett Gold. Now I want to look at Barrett Gold because gold has been extremely strong even during the sell-off, after the sell-off, and continues to be very strong. It's consolidated a bit for quite a few days here in this $36, $37 range. So let's say you think Barrett Gold is going to continue moving higher. So how can you play that? You can obviously buy a call option. So let's take a look at this. I'm going to select I'm bullish. I can buy 100 shares of the stock for $3,700. I can buy a call option for $380, and I can buy a call spread for $295 here. So let's take a look here. I'm not going to modify any of the expiration dates just for a second here. And I'm going to say, what happens if Barrett Gold moves higher to, let's say, $41 on earnings? Let's say the stock makes a jump, not a huge jump. Let's say maybe $40. Let's not expect a big jump because the stock has already moved almost 100% over the last couple of months. So let's say you think the stock's going to jump up another 10% to 40 bucks. A few days after earnings, which let's say is May 10th, and volatility currently here at 49% is relatively high. Like I said, I usually like to knock off about a quarter of that as a starting point. Now, as you can see here, this is really important, right? Because for many of you that don't have access to a simulator that can allow you to simulate these types of trades, you might say to yourself, I think Barrett Gold is going to go higher. Let me buy a call option. And then what happens is you realize that if the stock jumps 10% on earnings, which is not a small amount, and a few days after earnings, the stock jumps 10% and volatility comes down, look at how much return that I get on this particular trade, a 20% return. In the previous example, we had 126% return in Enbridge. Here, I only have a 20% return. Now, when you're just looking at an option chain, it's not obvious whether you're paying a lot for a call option or not a lot for a call option. So what we tend to find many times is that when you're trading these types of options, sometimes you might find yourself in a position where you're trading something that's more expensive than perhaps that you wanted to trade, and you're not able to find the strategy that you really want. But when you're looking at an option chain, $380 for a $37 stock isn't obvious that it's really expensive, but it really is. And that's why it has a low OptionsPlay score, because it's telling you that this call option is very expensive. What does paying for an expensive call option mean at the end of the day? It means a lower return if you are correct. And you still take on the risk that if let's say Barrett Gold pulls back to, let's say, $34 on earnings instead of jumping higher, you're risking 74% of your $380 to make roughly 20%. And you can say to yourself, well, that's not a great risk to reward. That's not a trade that I want to make. And that's why we created OptionsPlay, so that you can make these informed decisions before you place a trade and not come to this realization after you place this trade. Because we see too many investors that simply buy a call option because they see that they think a stock's going to move higher, without really understanding truly what the expected return is if the stock does move higher, and more importantly, what is the expected loss if the stock moves lower. And comparing those two side by side many times is going to help you make your investment decision. So let's just go through, I don't know, one more example here. Sun Life. Sun Life is a stock that really has been underperforming the market, as you can see with the technical score of 3, telling me this is underperforming the market. The 1 month and 6 month trend remains challenged here, where the 1 month and 6 month trend remains neutral and bearish. So I might take more of a bearish view here on Sun Life. So let's take a look. Stock's trading at $44. Buying a call option here costs $365. So first of all, again, this reports earnings on May 5th. So I'd be inclined to use maybe a May 15th or May 22nd option here. And so let's take a look at that. So let's say the stock goes down to, I don't know, $42 or $41 maybe on earnings. A few days after earnings here, so reports on May 5th. So let's say on May 7th or 8th. Again, knocking about a quarter off that implied volatility. As you can see here, buying this put option equates to an 84% return. That's not bad, considering that if the stock does jump up to, let's say, $48, I'm risking roughly 84%, roughly the same amount. So it's almost 1 for 1 here in this particular case. But I will say the reason that we want to trade earnings is that there's always the possibility that the trade really goes against you. And what you want to do is you want to protect yourself in the event there is the possibility the stock makes a big move to the downside. So we want to make sure that you understand how to utilize options here to make sure that you are utilizing options correctly. More importantly, utilizing in a way that allows you to take on a trade with limited risk, so that if you do get the directional view correct, right? And this is not to say that you will, but you know, sometimes even if you flip a coin, you'll get the direction correct sometimes. But when you do, you have unlimited gains to the upside. But on the same token, if you're wrong, you have limited losses to the downside. So with that, that covers what I wanted to show you here today. I hope that this was useful in giving you a quick glimpse into what OptionsPlay has to offer you in terms of the full platform. You can use it for all types of trading, not just earnings, but this is a prime example of how you can utilize this tool to quickly analyze any stock, whether you're bullish or bearish on it, strategies that allow you to trade a directional view with limited risk, but leverage the upside if you are correct, And then for those of you that are brand new, to use the trading simulator to simulate how a strategy is going to work in order for you to be able to trade these strategies. So with that, I'm just going to end this here on showing you this, again, how to access everything here for free. It's all available to you through the Montreal Exchange at optionsplay.com/TMX. To register for a free account gives you access to the full platform, as well as the options education, the weekly cover call and short put reports, all available at optionsplay.com/TMX. And for those of you that already have access to the platform, you can log in using tmx.optionsplay.com. So with that, I want to thank everyone for taking the time out here this afternoon. Again, thank you so much for participating with us here in the first options education day. You know, things are pretty crazy out there, so I'm hoping that everyone is able to stay safe. I want to make sure that everyone is doing their part in making sure that we're able to get through this as quickly as possible. So thank you so much for everyone for joining here today. So with that, I just want to do a pass over here to JP for him to do the next prize draw here. So let's go ahead and JP, why don't you go ahead and jump in here?